This is Michigan's retirement coach, Mike Douglas.
Tis the season for football and eating too much and family togetherness. It's not quite Thanksgiving yet, but I like to prepare myself. The family togetherness, I think, is the thing that I have to prepare myself.
It's right around the corner, though. I mean, we're 4 weeks away or so from Thanksgiving.
But my husband and I, we go to his parents' house for Thanksgiving, and they just have this little ranch home. But my mother-in-law wants everybody together, so we all pile in. So my brother-in-law and sister-in-law, they've got 3 children. It's me and Kyle, and then Drew, Kyle's brother, and his wife and their 3 kids. 1 bathroom for all of us to share. Kyle and I sleep in a bedroom. We've got twin beds, and so his brother will walk in and be like, Lucy! Making fun of us like I love Lucy.
You got some explaining to do.
But you know how Lucy and the old TV shows that husband and wife would sleep in the twin beds.
Slept separate. Yep.
'Tis the season for all the things, but also time of year, end of year planning is critical with the work that you do. If you're listening to us on Wood Radio this morning, you still have time to get to work and do things this year. There is still time. So if you have been thinking to yourself 2025 was the year and oh no, another year has come and gone, you still have time. We do have end of year appointments available still. So if you want to start that conversation with Mike, go ahead and give us a call, 616-512-2127. Or again, it's michigansretirementcoach.com. One of the big end of year conversations that you have, Mike, in the office with your clients is tax strategy. So let's start there and how taxes affect our retirement plan. Because if we reflect back when the Great Recession hit in 2008, we saw our 401ks cut in half as the market tumbled. Then money coach Tony Robbins said it's the 401k fees that can rob us of 10 years of our retirement money. However, according to a report, it's not market volatility. It's not the fees in our accounts. It's actually taxes that represent the biggest drain on our investment returns. Would you agree with that? Do you see this?
Absolutely. I mean, we see more and more that it's not only is it what drains, I think a lot of times it drains because it's the part we don't deal with. Like, it's a hot topic to talk about risk in the market. It's a hot topic to talk about fees paid to advisors and fees paid in the investments. And those are all important.
Yeah.
But nobody ever deals with taxes.
Right.
It is a real issue because our whole lives, we live in what's left. And I give this example all the time, but you take a new job and they tell you, hey, you're going to make an extra $10,000 a year. And you get really excited.
Yeah.
And then you get your calculator out and you can say 10,000 divided by 12 months. That's $833 a month. That's $416.50 per paycheck. I'm so excited for this extra $400 in my paycheck.
Yeah.
And you get your first paycheck and you're up like $187.
Mm-hmm.
And you go, what the heck? Where is my $400? Where's my $10,000 raise?
Mm-hmm.
Well, the federal government got a raise. The state got a raise. FICA got a raise. Hopefully your 401k got a raise. Everybody got a raise.
Yeah.
And you got what's left. And in retirement planning, we need to make sure that we are trying to keep as much as possible of what we've saved.
Right.
Because we can retire with $1 million, $2 million, $3 million, but that's a gross number. And then you have to live on what's left. Mm-hmm. We just met with a couple the other day. They're close to 60. They are moving physically to a new house into a new city. Mm-hmm. And while they have their savings, they have these 401ks of the jobs they just left. And we ran some numbers out, and they're at about $1.2 million in retirement.
Okay.
We ran the numbers, and over the next 25, 30 years, they'll most likely pay between $800,000 and $1 million in taxes on this $1.2 million.
Wow.
It's a crazy number because of the lifestyle, because of where they're living, because of what they want to accomplish. It was a huge number.
Huge.
And then they go through and say, that's not a 12% tax bracket or a 22% tax bracket. That's almost 100%. It's crazy. So we ran some planning and we did some strategies, and we basically built out a strategy that said, all right, investments matter, risk matters, but for us, taxes matter a lot. We want to keep as much of this 1.2 as possible. Mm-hmm. And what we did is we built a aggressive tax strategy. And by the time they're age 70, they will have converted or cleaned up all of their taxable income to the point where at age 70, they will pay no more federal income taxes the rest of their life. And instead of paying $800,000 to $1 million, over the course of their life, they'll pay about $400,000 in taxes. And it'll all be done by the age 70. And then they will have a completely tax-free retirement after age 70.
Wow.
This came from the fact that when we were talking, they said, how should I invest my portfolio? And I said, well, we should first of all not overpay in taxes, because your rate of return goes way up if you don't pay a ton in taxes. So we can do that. We can get a greater rate of return on your money.
That's interesting.
Without any more risk.
It did start
by
with
doing taxes.
But it's an investment conversation. They were asking about investment, and you're like, well, let's find out where the taxes are. An effort to determine the investment return. Yeah.
Did
I say that right? Did the words come out of my mouth correctly?
That's what everybody wants. Everybody says, how do I get a greater return with lower risk?
Okay.
Right. And then the next question is, do I get an annuity or not get an annuity? Which again, those are good conversations to have.
Yeah.
But if you earn 10%, but the government gets to rip out 3%, you really have what we call an after-tax return of 7%.
Right.
But nobody has these tax conversations. If you've saved a lot, but you've never looked at the tax side of your retirement, it's time. Taxes could be quietly, but consistently your biggest expense. Mm-hmm. If you want to have a conversation about your tax situation, understanding what it looks like for the future, give us a call, 616-512-2127, or reach out to us at michigansretirementcoach.com, and we can help you understand. The first thing is we have to map out what your taxes will be the rest of your life. Because without that plan, and we only know so much, right? But we know the laws, we know what we have now and what they're projected to be. Using those numbers, here's what you're projected to pay in taxes. How can we shrink that number? So if we can say, golly, over the course of your life, you can pay $300,000 less in taxes. And with the same rate of return, now you have an extra $500,000 to $1 million in your portfolio. Not because we increased risk, not because we increased rate of return. You just kept more of what you saved. I think that's a great place to start. Mm-hmm. Think about your first ever 401k. I remember when Kimberly and I started our first 401k, we were investing and we had 2 young kids. Mm-hmm. And Gavin and Zach Gavin was probably 3. Zach was like 1.5 maybe. Mm-hmm. And at that phase of life, everything's crazy expensive. Mm-hmm. Now, we didn't know what crazy expensive looked like because now we have 4 almost teenagers.
And we live in the world that it is now where gas is $3 a gallon.
Hyperinflated. Yeah. Back then, it felt crazy expensive because of diapers and because of all the stuff we were trying to do and build a business. And we sat down and decided to sacrificially save. And the sacrificial saving was going to be about $50 a week. And it was a sacrifice. Mm-hmm. It was like for our future. Mm-hmm. And if you're out there and you're listening, you've had these conversations. You remember your first 401k. Mm-hmm. And you sit at the dining room table and you figure out how we can possibly save $50 a week. Mm-hmm. And we did. And I remember telling her, this is going to be so great. Like, now we're going to do it. We're going to get our match. We're going to start building something really special. And we did it. And we got our first quarterly statement. And I'm thinking, here's where we find out that we're rich. And after a quarter of sacrificially saving and living on less,
$500.
we had $350.
Aww.
And I looked at Kimberly and said, what the heck did we even do this for? Like, we could have used this $350.
Yeah.
But 350 turned into 1,000, and then it turned into 5,000. It turned into 10,000, and then eventually it turned into $100,000. And as it grows and it continues to grow, I don't want to forsake how much of a sacrifice we made. Like, think about how long it took to get to $100,000. Mm-hmm. It took years to get to $100,000. At a point when it was harder to save than ever, we sacrificed to save. And a lot of our listeners have done that. They've sacrificed to save during hard years. But yet, because of lack of tax planning, we may pay an extra $100,000 to $300,000 in taxes. It's not just the number you're paying. It's the 10 to 15 years of saving that you did that just gets thrown away because nobody's willing to talk about taxes first, investments second. Because the average financial advisor just says, I work for this big box firm, or I don't do taxes. I'm an investment guy. You got to go talk to a tax guy. The tax guy says, I'm not an investment guy. I can't help you there. And as a result, you're chasing your tail and still paying more taxes. We just want to live a life where I pay as little taxes as I can over the course of my life. I don't give away 10 years of savings because nobody will help me build a tax strategy. And I don't have to risk up my portfolio to get more money. Mm-hmm. This is retirement savings. Market volatility is not your only risk. Yes, the dips will happen. 2008 happened, and it will happen again. Mm-hmm. But when you draw money out of your accounts, how is it taxed and what does that affect me long term? The market eventually gives back. The IRS doesn't. Remember that. If you stay in the market, it will give it back. The IRS is not altruistic. They will not give it back. Mm-hmm. Fees are part of the plan. Paying too high of a fee on your variable annuity, paying too much for your money management, those are fees. But we're talking about, should I pay 1.5% or 1% in fees, right? That's kind of what we're trying to split hairs on. But yet we may pay an extra 20 or 30% in taxes. I just think that we're missing the boat.
Okay.
You can't avoid taxes entirely, but you can outsmart them. But you need to work with someone, a CFP or someone who really specializes in taxes. And this is where we're changing lives. We build plans that aren't just investment focused. They are tax integrated. If you're talking to someone and they are only rates of return, they are only annuity, they are only stock portfolios, and they will not talk taxes, it's time for a second opinion. If you'd like to see what that looks like, give us a call, 616-512-2127 or michigansretirementcoach.com.
All right. So taxes, obviously, you're impassioned about that. But let's talk about the bigger conversation and the income planning and the strategy as far as our emotions in our retirement, because the number one fear in retirement, it remains the same year after year, study after study. We're afraid we're going to run out of money. However, that fear can often spawn another fear, which is the fear of spending our money. We're so afraid that we're going to run out that we clench on, and then we end up at 80 years old with more money than we ever had. So wealth manager Jeffrey Levine was telling the Decoding Retirement podcast, this is often where a financial advisor can help. This is what he said.
If you don't spend through it and you die with like $10 million, you've not followed your plan. It's a failure of your plan. It's a failure to the upside, which is certainly a lot better than running out of money. But if your goal is, I want to leave my kids $1 million and then everything else I want for my spouse and my enjoyment during retirement, then you've got to periodically reevaluate how things have gone versus what your initial set of expectations are. And in many cases, you can spend more than you originally planned, because when you start retirement, you're often conservative in case you happen to retire in a bad market scenario.
So how often do you review with your clients their spending plan for retirement? And then also, what do you say to them when they're clearly not spending enough? Because I know that this happens a lot.
Oh, yeah. This is a ton. And our biggest fear as a firm is that people die with more than they ever lived with.
Mm-hmm. No, because for you, that means you haven't done your job well.
Correct.
Yeah.
Right. I mean, it means as the person, like if you're the person who saved the money, you sacrifice, kind of going back into what we just talked about. You saved over the years. Mm-hmm. You put in the work, and I die and someone else reaps the benefit. So we really want to build a proactive spending strategy. And that does come from the tax conversation, right? We really analyze taxes. We make sure that these are dealt with. But why? Why do we deal with taxes? Why do we do income planning? So you can live the life that you've been dreaming of. You snowbird when you want to snowbird. You go golfing. You build a kitchen. You do the remodel. You do whatever you want to do. Why? Because it's all planned out. It's line by line, is detailed. Mm-hmm. I have some clients, Tom and Linda. They have over $1.5 million saved for retirement. They were disciplined savers their whole lives. But when they retired, they couldn't bring themselves to spend it. And I say all the time, it's the leopard doesn't change its spots just because it retired, right? Yeah. Like you're a saver, you're a saver. Right. You're a spender, you're Discipline. A spender. Yep. And the hard thing is, and I have people come in, they'll have a couple $1 million and they are nickel and diming over the stupidest stuff in retirement. Mm. I'm like, golly, guys, you can just live, just spend it, just buy the better golf balls, just do the stuff you want to do. And they're like, I can't justify spending that. And that's why they have the money they have.
That's right.
You have to have a comfort level. So what we try to do is we try to set up mandatory income for those who won't spend. Why? Because it's going to show up in your bank no matter what. It's not an option. Okay. So what we try to do is we make these structured income plans where their retirement paycheck is steady, consistent, and guaranteed. Mm-hmm. So for those who say, well, I need $5,000 a month to live off of, that's great. And if that keeps your lights on, it covers you going out to eat, doing all the little fun stuff you want to do, that's great. What happens when we force feed you $8,000 a month after taxes? And it shows up and you say, well, I needed $5,000. Right. But we ran the numbers out over the balance of your life. And if we don't spend $8,000 a month, you're going to end up with this chart that shows you dying with $10 million, but having lived on $60,000 a year. What are we doing? So instead, what we do is we try to set up these force-fed incomes where it's coming to you. Then what would you do with it? Well, I don't need it. Okay, great. Who can we gift it to? How can we love on your grandkids? How can we give to charity? How can we want to make sure that we are doing things in a way that you die with zero regrets, but still plenty of money. So if we make that model and it works out, it comes from structured income, consistent income, and constant conversation. We have what we call a green line philosophy. We have a number that we want your retirement portfolio to stay at to keep us all safe, right? If long-term care hits, here's how we pay for it. If survivorship happens, if a major medical, if a roof goes out, whatever. We want to keep a certain level in our retirement accounts. And for every couple, that's different. Every family, that's different. Once we get above that number, we want to spend it back down. We want to make sure that we are using the money to create life in the years. So I had one client who every 2 years, we would recheck in. Where am I? Well, we're ahead of schedule by 40 grand. Great. Send me 30,000. And he took his kids and grandkids. He had 2 kids, 4 grandkids down to Disney, and they did Disney all the way.
That's
it was
awesome.
$30,000.
Yeah.
And it was $30,000 gross. They got $24,000 after taxes.
Okay.
And they went and in 1 week blew $24,000.
I bet they did at Disney World. Heck yeah.
Yeah. And that was almost just the food, right? Like it's crazy how much Disney costs. But they did it out of the overflow, out of the surplus. Because remember, we had a baseline and this was, we're 40,000 ahead. Send me 30 so I can go do something cool.
Yeah.
And so that's the plan. It's that constant revision of, hey, has your life become more expensive? Has anything changed? Do we need a new vehicle? Whatever that looks like. And you build that in, but then also you say, we're starting to stockpile too much. We're getting too much in the barn. We got to get some of this out. And so we start trying to find ways to spend it. I don't need it. Okay, great. Let's gift it to grandkids. Let's gift it to charity. Let's make some difference in the world. Let's find ways to be beneficial rather than just seeing this money grow. That way the advisor fee can go up and that way your kids can inherit more money. Let's do some stuff. And that's also where we come back to that term living inheritance. We talk about it all the time. When I die, Mike and Kimberly dies, our kids are going to get money. Like there's no way around that. But what can I do with them while we're living to enjoy it with them? Can we take them on a trip to the Grand Canyon? Can we take them on a trip to see Mount Rushmore? Can we take them around the country or around the world on vacations? That way, while we get to see it, we get to see it with them. When we took my kids to Hawaii a couple years ago with my parents, now my dad spent 21 years active duty in the Army. He just passed 29 years as a civilian. So he's got 50 years in the military. And we were at Pearl Harbor on Memorial Day with my dad and my kids, getting a tour of the Arizona, getting a tour of all the stuff through my dad's military eyes as he explains it to my kids. I can't put a price tag on that. Well, Delta did, and the people that we had to pay for that trip did.
Yeah.
But it was a life-changing experience for all of us. And that's a living inheritance moment. We can die with a lot of money or we can do things with family. And that's what we're trying to build. An income strategy that keeps calling you back to why you saved to begin with. It's not about dying with this big account balance. It's about living with the most peace of mind and checking off every box. If you're unsure whether your spending matches your plan, if you're unsure that you're on a place to make sure you use this stuff the right way, let's have that conversation. We will help build a retirement income strategy that lets you enjoy the years you work so hard for. Give us a call, 616-512-2127.
When you think life insurance, most of us think about some sort of term product that we might have gotten when we were in our 20s, young families, maybe very often a one-income circumstance. You got to protect that spouse that isn't working and the kids, et cetera, if something were to happen to you. However, there are other ways that life insurance can be utilized for retirement planning. And that's what I wanted to ask you about. Just kind of some basic life insurance, retirement planning, correlation information. That what do we need to know about this in this space?
Yeah, absolutely. Before we go into, I know we focus a lot on retirement planning in this, and it's important because that's our people. That's who we work with.
Yep.
But life insurance is such a in-the-moment thing for us right now. This summer's been a really difficult one for us as we've lost 3 friends and people my age I say my age, within 10 years of my age. A good friend of ours was driving from Lansing to Grand Rapids and killed in a car accident. My assistant basketball coach, who our sons play basketball together, he was out for a run and got hit by a car and he passed away. And then another one of our friends who is younger, he actually had a brain tumor and cancer and passed away. All three within the last 6 weeks to 8 weeks of each other. So we're going to get into the retirement planning piece, but if you have kids who are in their 30s and 40s and they're going through, please have that conversation with them, because 30 and 40-year-olds feel invincible, like they don't need life insurance and they don't want to have the coverage that's needed. But if you have a young family and or if you're listening and you're one of these people, I mean, these are wonderfully healthy people, not the friend who passed away from the brain tumor and the cancer, but the other two were just living life, regular thing with young kids.
Yeah.
And just driving to work and did nothing wrong, got rear-ended and then slammed into a semi-truck and passed away. The other friend, a healthy guy, a doctor, the story got actually a lot of press here on the West Side, but it's like he was out for a run. He was serving at a Christian camp for the week, took a week off of work, serving at a Christian camp, doing music and helping as a counselor, and goes out for a run and gets hit by a car and dies. Has young kids. And these moments happen so quickly. And so I've got a lot of friends right now who are reaching out to me in our community saying, do we need life insurance? Yes. If you're a young family and you have young kids, you are single income or a dual income, you need life insurance. This is not from the sake of trying to make a sale here. I don't care if you call us or call somebody else. But if you're a young family, get some term life insurance to protect your family. Kimberly stays at home with our kids and homeschools them. I have life insurance on her because if something happens to her, I don't know what we're going to do. But I need enough insurance to pay for someone to help clean the house, to help educate my kids, to help do all the, there's a lot.
Yeah.
So before we go into retirement planning, please encourage those around you. Let's not avoid life insurance as a conversation.
And term life insurance can be you can find some very affordable options.
Yeah, that's the problem. They always say, it'll never happen. I don't need it. I have 3 friends this summer who needed it.
Yeah. If you do want somebody to help you with that, Mike can help you with that. If you've got kids that are in this phase of life, or if you're listening, Mike can help you. Even though, yes, you focus on retirees, you can help with this kind of thing, right?
Yeah, absolutely. Encourage your kids to get it. Have that conversation. We'd like to help you with that. But if not us, somebody. Talk to somebody about getting life insurance, please. If you'd like to talk to us about it, give us a call, 616-512-2127, or go to michigansretirementcoach.com, and we will help you have that conversation.
All right. PSA
now,
done.
All that being said, how can retirees, as we look forward into our retirement, what happens when I don't need that replacement of income insurance anymore? What do I do as I'm getting to the point where my term insurance is coming up and I don't need it anymore? Is life insurance even still a viable tool for a retiree? Yes, there is a point where it makes sense. There is tax advantaged growth inside of whole life policies. And there's people who listen right now who say, hey, Dave Ramsey said never buy whole life insurance policies. I get it. He firmly believes that you should get term insurance and buy the S&P 500. And if you are someone who is in the range of $300,000 of retirement savings to $1 million of retirement savings, it may not make sense for you to use whole life insurance as part of your strategy. But once you get above $1 million to $2 million, it absolutely makes sense to use life insurance as an investment vehicle. You can put money in, you get your premiums put in, it grows with zero risk in certain policies. You can take money back out tax-free as income in retirement and use it for a tax-free lifestyle. And you provide a death benefit if something happens to you. It also provides long-term care benefits. I just sat with someone. We built a plan out for them. They had this old policy, this old whole life policy that they had years ago. And in their minds, it was a just for death benefit. We restructured it and said that we could use the cash value inside of it. Let's use it for income, borrow from it. So we started building that thing. And it had a long-term care rider.
Okay.
That's a big thing because one of the biggest concerns people have is, how do I pay for long-term care? Well, ideally with an insurance company's money, not your own. But by the time you get to age 70, 72, 73, it starts getting really expensive to continue to own your old long-term care policies.
Yeah.
And oftentimes you're paying in, hoping to never use it. And if you never use it, you just paid for someone else's benefit. So we had someone, he's a business owner who, as we're going through and identifying concerns he said, well, what do we do about long-term care? We said we helped him structure a plan where his business bought a life insurance policy on him. And the business is able to deduct the premiums. Not always, but in the right structures, the business can deduct the premiums. It's his policy. He puts in over a couple years, chunks of money. And we know that with life insurance, you put in a certain amount and your death benefit is 3 or 4 times that typically, right? The death benefit can be used for long-term care, tax-free. So if you pull from your IRA, your 401k to pay for your long-term care, it costs you more than $8,000 a month because of the taxes.
Right.
It costs you more than the cost of the care because you pay taxes on every dollar that comes out. If you use life insurance, it can be tax-free coming out. And then at the end, all you're doing is reducing the death benefit in the future. But if you never need it, your family gets the death benefit. So I didn't pool into someone else's benefit. I at least got something out of it. So is it for everybody? No. But it is absolutely part of our private wealth strategy. If once you get to beyond $1 million to $2 million and you start figuring out how do I handle this estate, it's a great tool. If you don't believe me, look up Jim Harbaugh's University of Michigan contract. He's coaching football at University of Michigan. His deferred comp plan was a giant life insurance policy.
Oh, really? Interesting.
Michigan paid $2 million a year for 7 years. They paid in $2 million for 7 years. They put in $14 million. All through his retirement, he gets to take tax-free income out. At his death, Michigan recoups the $14 million, and his family gets what's left of the cash.
Wow.
So this isn't me talking about it. University of Michigan did it for Jim Harbaugh's deferred comp plan. If you want to look into that, that's what it is. It's a real thing. But life insurance is there to help with long-term care, to provide for your family if something goes wrong, or to give you tax-free income in retirement. If you want a strategy that protects your estate from estate taxes, protects you from long-term care spend down, protects you from risk in the market while still giving you tax-free income, this can be a good solution. If you'd like to talk through that, give us a call, 616-512-2127.
Mike and his team, they're here for you. MichigansRetirementCoach.com. You can go there to start the conversation with Mike and his team to help understand what's going on with your retirement savings. We've also got links posted in the show notes. Or again, it's MichigansRetirementCoach.com. Let's get to work helping you understand. It's your money. You got this.
Thanks for listening to Michigan's Retirement Coach with Mike Douglas. To learn more, visit MichigansRetirementCoach.com.
Michael Douglas is an investment advisor representative of Stewards Wealth Planning, LLC, a registered investment advisor. Financial professionals are not licensed in all 50 states. To find out if Michael Douglas is licensed in your state, please call 517-323-7526. Stewards Wealth Planning, LLC is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Michael B. Douglas, NPN number 9650939.